guys, it's Brett Sampson with Berkshire Lending. I wanted to go over and do a video for you today to explain a particular product, just one product that we're doing more and more of these, and I want you to know how they work. I get a lot of questions about them, and I want you to know where you can use them, where you can't use them, and go over some pricing on them. I thought about doing a PowerPoint presentation, but I just thought it would be easier to use my screen and go over an actual matrix from one of the underwriters that we use on this product. So I made some notes here. Let's just go through it. The loan is called DSCR. I'll just write it out. Debt Service Coverage Loan. That's an acronym for Debt Service Coverage Loans. So they're called DSCR loans. Restrictions, really there's two big ones. One is it's only for investment properties, non-owner occupied. You cannot live in a property where you're going to use a DSCR loan. And you can only go up to 4 units, 1 to 4 family units. So anything above that, you cannot use it. So let's go over some of these guidelines for it because it's a cool product. The big advantage, I'll tell you, and we'll get into it a little bit, but the big advantage is there's no income documentation, no bank statement deposits, no tax returns, no pay stubs, nothing. The only income that is of a concern is the rent amount. So whatever the home rents for, that's the income, and as long as that covers the mortgage payment, we're good to go. So you need a minimum 620 credit score for this type of product. You can see down here, this is a reserves requirements section. We're just going to focus on DSCR here, but you can see there are 0 months of reserves for debt service coverage loans, which is wonderful. It's great. And based on your credit history, you could be downgraded on your pricing. So if you've had a Chapter 7 or 11 bankruptcy, in the last 4 years, no effect. 3 years, not much of an effect. You lose the A+, and then 2 years, it's going to be B. So all that means is your pricing is going to be worse if you have had a recent bad credit thing happen to you. Minimum loan amount $100,000, maximum loan amount $400,000. So let's get to some of the stuff that I wanted to talk about. You can do interest only on these, but I haven't done one of those in a while, but it's available. And here you can see you can go up to 2 to 4 units, or you can do it on a single family home. And the loan to value ratio is up to 85%. Okay, that's on a purchase and rate and term. Cash out 70%. So let's go through here. Purchase rate and term up to $1.5 million. You can see it breaks it down by credit score. So the worse your credit score, the lower the loan to value, the more you're going to have to put down. So let's go over this for a minute. DSCR 1 plus, DSCR 0.75 to 0.99. What this means is if the home is currently leased and you have a lease agreement in place, they can use that lease. Otherwise, the appraiser will do a rent schedule, which is an addendum or attachment to the appraisal that he does a rent analysis for that community. And if the rent analysis he comes up with is equal to or greater than the full PITI payment, then you have a 1 plus. So let's just say the payment is $1,500 a month, and the house will rent for $1,500 or $1,600 a month. Then you have a DSCR of 1 plus. That means the rent payment more than covers, or at least covers 100% of the payment, the PITI payment. And you can go up to, if you have good credit, up to 85%, so 15% down. The worse your credit, the more you're going to have to put down. So let's say the rent does not cover the mortgage payment, right? Let's just say it's 0.75. Below 0.75, they won't do it. But that affects two things. One, it affects your LTV. Your loan to value ratio will be worse. You'll have to put down more money. If it's a purchase, if it's a rate and term, you just won't get as much loan. The other thing it's going to affect is pricing. When you put in DSCR 0.75, the pricing will be worse. Okay. So you can see here it's broken down on loan amount, 1.5 million, 2 million, and over here they have 3 million. Cash out refinance. So you can see the cash out numbers are lower on the loan to value ratio. And this particular product goes all the way up to $3 million. To get this, you have to have at least a 680, and then you can see here you're going to need a 30% equity position if you have a 700 or better credit score. They don't really calculate a debt to income ratio for debt service coverage. All they just do is the monthly rent, like I said. Debt to income ratios are more for alt doc, like a bank statement loan or a traditional doc loan. There is a prepayment penalty. You know, when they passed the Frank-Dodd Act after 2008, one of the things it did was it outlawed prepayment penalties on owner-occupied mortgages. But on investment properties for non-owner occupied, for non-QM loans mainly. Non-QM is the family of loans that alt-doc loans belong in, bank statement loans, DSCR loans, those kind of loans. There are prepayment penalties. So basically it's 6 months of interest. If you owe more than 20% of the original loan balance, you're going to have to pay 6 months of interest if you get out of it. I did some pricing for you, so let me just bring it up and we'll take a look at it, okay? I just happened to mouse over this, that's why that one's blue. There's nothing other than that special about it. You can see the different credit grades here, A+, and then you have your prepayment penalty variation. So with the 5-year prepay, the rate is lower. And yes, the rates are higher than if you used tax returns and traditional documentation. That's the price you pay for this. Although this is what we call the par rate. You don't have to pay extra to get a lower rate. But if you wanted to go, let's say 3.875 or 3.75, you would just have to pay some discount. Like to get to 3.875, you'd have to pay a 1/4 point discount, for instance. And then if you have worse credit, maybe a housing event, you can see here the pricing is worse. Same prepay, 5-year prepay, but it's A instead of A+. So for that, you're going to pay an extra 1/2 point, right? So this is an idea of the pricing. And again, the great benefit of this program is you don't have to mess with income docs. All you got to do is, you know, if you're buying a house, you get a contract, we order the appraisal, and, you know, hopefully the rent looks good, and that's all that matters is the rent on these things. That and your credit score and what that looks like. But that's how these loans work. If you want to reach out, contact our office and get some individual pricing on an individual property, I welcome you to do that, and we can help you out with that, okay? Again, this is a debt service coverage loan, all right? Thank you. Bye.